Hi everybody, today we are going to talk about Greece, the how, what, and why of what has happened. So what does it mean for you? How have we gotten to this situation? So first step is, how did they get there? Ultimately, they were spending more money than they were taking in, and they've created this large problem. Now the buyers of their debt, countries like Germany and Spain, bought their debt on certain assumptions. Those assumptions turned out not to be true. So let me give you an example. If I'm going to invest in company XYZ and I believe their revenue is whatever it may be and their debt is so much, I'm expecting a certain risk associated with that investment. Now, if it turns out that their debt was really 2 times as much and their revenue was half as much, well, all of a sudden, the risk that I assumed I was taking is much greater. That leads to big problems. That's exactly what has happened with Greece, and it happened really over and over again once the numbers were really dug into and found. They were spending a lot more than they said they were, and they weren't taking in quite as much as they were assumed to have been. So what is happening now is they're as of last week, they did not make their first payment of $1.55 billion to the International Monetary Fund. Think of it in terms of your mortgage. You skip that first payment, now the bank starts to worry. Now things start to potentially snowball, and that's a large concern. This has happened before in 2010 and 2012, and they were bailed out by the International Monetary Fund and by the other European countries. So really what it means, or why does it matter, is what should be most important to you, the investor here in the United States. I certainly hope that you're not heavily weighted to Greek stocks, but you might own 1 or 2 if you own a target date retirement fund, say in your 401k. But what it really means and why it matters is it leads to uncertainty in the markets. No one knows as of now for certain what the outcome is going to be of this crisis in Greece. If Greece defaults on its debt and the International Monetary Fund doesn't try to get their money back, that could set a precedent. It could create a snowball effect out in other European countries. That obviously is negative. It could get resolved. They could be bailed out. If Greece defaults, the countries that have the largest portion of that debt, Germany and Spain, can easily absorb it because Greece is a very tiny economy. Just to give you an example, relative to the size of Apple, the company, Greece is 25 times smaller than just Apple, the company, in terms of their equity market capitalization. So why it matters is that you should have a reasonable exposure to European markets. And with that uncertainty can create volatility. But as an example, that volatility and uncertainty leads to potentially better pricing, better value, better bang for your buck. So as an example right now, U.S. companies priced relative to their earnings is extremely high compared to European countries priced to their earnings. Now, am I saying that you should go out and buy all European stocks and take a large risk on that? No, but you should be diversified throughout the entire globe. Be disciplined in your approach. Own international stocks, own domestic stocks, own emerging market stocks, and have a disciplined long-term approach. And what happens with a small country like Greece really shouldn't be a big deal because you're thinking out 10, 15, 20 years for your retirement, for the rest of your life, for your inheritance, whatever it may be that's specific to you. So if you have any questions about how this or what this may mean to you, then call us, 770-984-2312. Go to our website, bearwealth.com. I hope that you have a great week, and I'll hopefully talk to you soon.